I want to show you something that sounds like a scam and isn't. $10,000 invested correctly, not actively managed, not day traded, not put into a hot stock tip your coworker mentioned at lunch, turns into approximately $500,000 over a specific period of time using a method so boring that the financial industry has spent decades trying to convince you it isn't enough. It is enough. It is, in fact, more than enough, and the evidence for that statement is so comprehensive and so consistent across so many decades of market data that the argument against it almost exclusively comes from people who profit when you choose something more complicated instead. Today, I'm going to show you exactly how it works, the specific account, the specific fund, the specific behavior, and the specific timeline that turns $10,000 into $500,000 without requiring you to watch the market, research companies, time entries, or make any decision beyond the one you make today. My name is William, and the method is genuinely as simple as what I just described, which is the part that takes the most convincing because we've been trained to believe that results this significant require effort this proportional. They don't. Not here. First, the math, because you need to see the actual numbers. $10,000 invested in a total market index fund at the historical average annual return of the U.S. stock market, approximately 10% over the past century, approximately 7% after inflation, produces the following outcomes depending on time horizon. At 10 years, approximately $25,937. At 20 years, approximately $67,275. At 30 years, approximately $174,494. At 40 years, approximately $452,593. At 42 years, approximately $549,177. The $500,000 threshold is crossed at approximately 41 to 42 years at 10% annual returns. At 7% real returns over 42 years, $10,000 becomes approximately $163,000 in today's purchasing power. Meaningful, not $500,000, but meaningful, and that's before we add the behavior that actually makes this strategy powerful. The lazy method. Exactly what it is and why lazy is the right word. The method has 4 components. All 4 are simple. 3 of them require one decision each. 1 of them requires no decision at all once the others are in place. Component 1. Open the right account. A Roth IRA at Fidelity, Vanguard, or Schwab. If you're self-employed, a SEP IRA or solo 401k. If your employer offers a 401k with low-cost index fund options, that account. The account type determines the tax treatment of everything that grows inside it, and tax treatment, compounded across 40 years, is worth more than almost any other variable in this equation. A Roth IRA specifically means the $500,000 your $10,000 becomes is entirely tax-free at withdrawal. The IRS does not collect on any of the $490,000 in gains. That is not a detail. That is a 6-figure difference in the real outcome. Component 2. Buy the right fund. VTI, Vanguard Total Stock Market ETF, or FZROX, Fidelity Zero Total Market Index, or SWTSX, Schwab Total Stock Market Index. Any of these. Expense ratio, 0.03% or lower. What these funds do, they buy every publicly traded company in the United States simultaneously, weighted by market capitalization. When Apple does well, you benefit. When a company fails and gets replaced in the index by something better, the replacement happens automatically without any decision from you. You own the entire market. The entire market has gone up through every war, every recession, every crisis, every period where it seemed like it might not for the past 100 years. You were betting on that continuing. That is the bet. Component 3. Invest the $10,000 today. Not when the market feels safer, not after the next correction, not when the news is less alarming. Today. The research on market timing is unambiguous. The market spends most of its time at or near all-time highs because it trends upward. Waiting for a better entry point means waiting on the sidelines while the market does exactly what it has always done: recover and reach new highs. The person who invested $10,000 at the worst possible moment before every major crash since 1970 still built meaningful wealth by staying invested. The person who waited for the right moment never found it. Component 4. Do nothing. This is the lazy part. This is also the hardest part, not because it requires effort, but because it requires resisting the effort your brain wants to apply. When the market drops 20%, the correct response is nothing. When a specific sector is outperforming the index and someone suggests you should concentrate there, the correct response is nothing. When a new investment product promises better returns with lower risk, the correct response is nothing. Your job after investing the $10,000 is to not interfere with what you just put in motion. Why doing nothing is harder than it sounds, and why it matters more than the fun choice. The behavioral gap, the difference between what the market returns and what the average investor actually captures, is one of the most consistently documented phenomena in investment research. J.P. Morgan's annual guide to the markets tracks this gap annually. Their most recent data shows that while the S&P 500 produced approximately 9.9% annually over the past 20 years, the average equity investor captured approximately 6.0%. The gap, nearly 4 percentage points annually, is not explained by fund selection or expense ratios. It is explained almost entirely by behavior. Selling during downturns, buying after recoveries, chasing recent performance, switching strategies when the current one feels insufficient. On $10,000 invested for 20 years, the difference between 9.9% and 6.0% annual returns is the difference between approximately $66,000 and $32,000. The behavioral gap, the cost of not doing nothing, is $34,000 on a $10,000 investment across 20 years, not from choosing the wrong fund, from reacting to the market instead of ignoring it. The lazy method works specifically because it removes the behavioral variable. You invest, you set the automatic monthly contribution, you don't watch, you don't react. You check once a year to confirm the automation is running. That's the entire active requirement of the strategy from month 2 onward.
The addition that actually gets you to $500,000 faster, monthly contributions. $10,000 invested once at 10% annual returns reaches $500,000 in approximately 41 years. That timeline is real, and it is too long for most people to find motivating in the immediate term. Here's what monthly contributions do to that timeline. $10,000 invested today, plus $200 per month at 10% annual returns, approximately $500,000 in 28 years. $10,000 invested today, plus $400 per month at 10% annual returns, approximately $500,000 in 22 years. $10,000 invested today, plus $600 per month at 10% annual returns, approximately $500,000 in 19 years. The monthly contribution is the variable that collapses the timeline from generational to personal. The $10,000 is the foundation, the base that starts compounding immediately. The monthly contribution is the accelerant. Together, they produce the $500,000 outcome on a timeline that is relevant to the life you're actually planning, rather than the abstract future you're theoretically building toward. The $200 monthly contribution, $2,400 annually, is the cost of one streaming service upgrade, one fewer restaurant meal per week, one subscription audit. It is not a dramatic sacrifice. It is a reallocation from consumption to compounding that the future version of you cannot adequately express gratitude for. The things that derail this strategy, named explicitly so you can avoid them. Individual stock picking. The average actively managed fund underperforms its benchmark index in approximately 92% of cases over 15-year periods, according to S&P indices versus active data. The individual investor picking stocks without the resources of a professional fund manager underperforms at an even higher rate. The lazy method beats active management not because it's smarter, but because it's cheaper and more consistent. Don't complicate it. Panic selling. The 10 best trading days in any given decade are responsible for the majority of that decade's total returns, and most of those days occur within 2 weeks of the worst days. Selling during a downturn and waiting for stability means missing the recovery that begins while the news still looks terrible. The $10,000 you sell at the bottom is the $10,000 that doesn't participate in the recovery. Hold. Lifestyle inflation consuming the monthly contribution. The $400 per month that gets you to $500,000 in 22 years needs to survive the raise that arrives in year 3. Automate the contribution before the income increases have a chance to be absorbed by upgraded spending. The automation protects the strategy from the behavioral pattern that dismantles most savings plans. Not dramatic failure, just gradual consumption of the margin by an expanding lifestyle. High-fee alternatives marketed as superior. Whole life insurance presented as an investment. Actively managed funds with 1.0% expense ratios. Structured products requiring a glossary. The lazy method's 0.03% expense ratio is not leaving performance on the table. It is capturing the performance that the expensive alternatives consume in fees before you see it. The complexity is the fee. Avoid both.
The $10,000 is not the impressive part of this story. The impressive part is 41 years of doing nothing while the market does what it has done for a century. You don't need to be smart. You don't need to be informed. You don't need to watch the market, follow the news, or understand anything beyond the 4 components described in this video. You need to start, you need to automate, and you need to be boring for long enough that the math produces the number you're looking for. The lazy method works because the market has been working for 100 years. Your job is to not get in the way of it. 4 components, 1 automation, 40 years of doing nothing. That is the entire strategy. Subscribe for a new video every week and drop in the comments how much you currently have invested. No judgment, just data.